Hello, happy Thursday. We are right back at it after a shorter week of trading with jobs and inflation data kind of filling up our conversation today. But we also have a really good follow-up question of the week all about CDs versus money markets that we'll kind of break apart. My name is Brandon Steele, financial advisor with Mainsail Financial Group here in Bellevue. And our goal every Thursday is to bring to you the market news, data, trends that we're watching, hopefully weed out a bit of the noise here along the way. So hope everybody had a great Easter and Masters weekend here recently. It was definitely fun to watch some good golf there last weekend. So hope you're able to enjoy that. But we have quite a bit to cover. I'm going to spend a bit of time on jobs and inflation, but I do want to really break apart our great question of the week about CDs versus money markets here. So Friday, let's go back to last week. Remember, Friday was closed for Good Friday, but nonetheless, we did have an important data point come out. We had non-farm payrolls come out. Basically 236,000 jobs were added. This was pretty much right in line with expectations, but the reality was that it was a big pullback from last month's data point. So again, nothing that kind of like upset expectations there by any means, but it is a pullback. And as I've mentioned, we have been seeing some slight kind of cracks in the labor market very near term, very recently. So we'll continue to keep a close eye on the jobs data, but this is going to be really important as we look towards the Fed in May. Wednesday, we had CPI data come out. So obviously, we got jobs and CPI. We're talking Fed here because these are the two things that they're watching. Core CPI inflation was up 0.4%, which was basically, again, right in line with expectations. It was down slightly from last month. Last month was up 0.5%, but down slightly. On top of that, on Wednesday, we had the FOMC minutes come out from the last meeting there in March. Remember, March, not anything coming up. This is from the last meeting. And what I thought was important to maybe mention here was that all of the Fed officials backed a 25% basis point hike in that meeting. So there was a lot of conversation about maybe they wouldn't do it, maybe they would go 50, but mostly on the side of maybe they wouldn't do it because of some of the bank turmoil. The reality is that even with all this media coverage saying that, obviously they did 25 basis points. And in fact, every single official apparently backed that, that rate increase. So maybe some overhype, going on there as far as the media side of it. But it certainly solidifies their path and what they are looking to accomplish. I think between this FOMC minutes release about, everybody backing this and the CPI data on Wednesday, what we saw towards the afternoon was the market started to peter out a little bit. And I think it was really because, they were expecting inflation to be a bit more tamed, I guess, at this point. Obviously, that is not the case, although it did decrease slightly. I think a lot of the market was expecting this number to really come in quite a bit lower. So, I guess my takeaway from all this is I want to say it's still very early ahead of the May meeting for the Fed, and I'm really cautious to give my thoughts too early, but I do think it's very likely the Fed's going to do another 25 basis points hike there on May 2nd. We'll continue to watch that. There's obviously a ton of data that can come out between now and May, but nonetheless, those two pieces of data plus the jobs sort of starting to slow, possibly, but not clearly, I think kind of leads towards that, which puts them at their target rate that they had mentioned a long ways back and really just, finishes the story basically for them to maybe take a pause after that. Today, on Thursday, we had PPI come out down 0.5% actually. So expectations were this would be flat. We actually saw this number down, kind of a flip, I guess, as far as that versus the CPI data. So we'll continue to watch that, but it was interesting to see that number this morning. And then we had initial jobless claims come out at 239,000. So again, slight cracks, nothing significant, slight cracks maybe in the labor market. And the only reason I say that is because it's a slight increase from last week, but nothing significant, right? So keep that in mind. Last thing I'll mention before we get into our question of the week is just to keep an eye on markets. Right now, we're kind of at the top of the range that we've been in. If you remember going back from, really beginning of 2022, we've really been in this range. Right now, we happen to be at the top of it. So we want to really watch closely what happens from this point and see if we either kind of bounce off of that or potentially break through it. But we are at an important part of this kind of market range right now. So be sure to tune in next week. We have retail sales, we have consumer sentiment, and continued focus, obviously, on this jobless claims as this number is becoming more and more important. All right, with all that said, before we get too far ahead of ourselves, let's take some time on this great question of the week about CDs versus money markets. And I think there's a great follow-up from our conversation last week, which was about, what is a great low-risk investment? So if you haven't seen that one, take a look at last week's market update. But this week's question is really relevant. Right now with rates higher, it's much more exciting to be looking at cash as an asset class. Whereas, you go back just not even a full year, but let's say a year ago, it was more of a defensive position than anything that gave you any sort of return. Now, obviously, if you look at the rates compared to inflation, not great, but, maybe as inflation tames, hopefully in the next, year or so, these rates could be strong. And so the question comes up, well, if I am looking at options for my cash to get a little more out of it, do I look at CDs versus money markets? And as you probably could guess, my typical answer to these types of questions are it depends, but I'll break that apart a little bit more and kind of help guide a little further than that. Generally, both instruments pay a higher rate of return, a higher interest rate than you would get in a passbook savings or a checking account. But the question comes up, well, which one do we look at and why would we look at each? So let's put it this way. If CDs, how they work in general is you give money to the bank, certificate of deposit is what that stands for. For that, they give you a fixed rate of interest to hold your money. Now, the key to CDs is the hold your money part. Generally, CDs are locked up. It doesn't mean you can't access them, but generally, if you do, there's a penalty. Typically, it's lost interest, but really, they're meant to be held for that period of time. Money markets, on the other hand, may offer a slightly lower interest rate, not always, but slightly lower interest rate. But the exchange is you can access that whenever you would like. You can pull the money out whenever you would like. To some degree, there can be limitations for how many times in a given month, but generally they're much more flexible, right? So the question is obviously which is better, and I think it depends on what you're trying to accomplish. Because if you are putting money aside that you want to have access to, or let's say you may possibly need in 6 months or a year or whatever it is, generally it may make more sense to look at a money market. If they're paying similar interest rates and we need some flexibility, a money market can be a great way to provide that flexibility, not lose necessarily a lot of interest in the meantime, and avoid the whole idea of locking up those dollars as well. Because although rates could come down, they also could go up. And in that scenario, in a money market, you could get a little more for it. Where CDs can be very helpful is if you're maybe keeping money aside for a little bit longer. Right now, we are at a higher interest rate environment. And I don't know this, but it is likely we could see rates come down over the next year or 2 or 3. If that happens, obviously CDs could be a great place to lock in, let's just say maybe a 4 or 5% rate for 3 years when rates don't pay that anymore at that point, right? That's the way I would kind of look at CDs, is they're a great way to lock in a higher rate, whereas a money market is going to fluctuate with rates. There's a little bit of a drag on that. It's not, it's not following it day to day. But nonetheless, money markets are going to fluctuate based on interest rates at the time. Whereas CDs, once you're in, you get that fixed interest rate. Now, again, for that, you lose the liquidity aspect of things. The last thing I'll touch on as well is that CDs are technically FDIC insured. Money markets are not. So that is something to be aware of. But money markets are, of course, a very, very conservative asset class. I can't say that they are risk-free by any means, but they're much different than they were back in 2008. For instance, they're much more conservative than they used to be. But definitely look under the hood when you purchase a money market and make sure that you know what's in there as well. For instance, maybe you want treasuries as opposed to corporate bonds or something along those lines. So I hope that's helpful. Very good question this week, very relevant with rates and where they're at. Be sure to tune in next week as we'll kind of continue this focus on the jobs number and also talk about where we're at as far as the market range that we touched on earlier. Have a great upcoming weekend. We will see you next Thursday at 3.